Hi dears, myself Nusrat Shimna, Assistant Professor, PG Department of Commerce, GEMS Arts and Science College. In today's session, we are going to discuss about some basic terms related to income tax. To make an in-depth study into the subject income tax or to understand how the income tax works, first we must learn about the basic terms in tax. There are a lot of terms related to income tax, but a few of them are discussing in this video. Okay. In my slides, you can see the basic terms that I am going to discuss that are SSC in default, previous year, assessment year, income, gross total income tax returns, accelerated assessment, etc. Okay, we can go through these terms one by one. First term is assessee. An assessee is any person or entity legally required to pay tax, interest, or other sums under the Income Tax Act. This covers individuals, companies, HUF, Hindu Undivided Family, firms, AOP, Association of Persons, BOI, Body of Individuals, and Local Authority. So the term assessee simply means that any person who pays any sum of money to the income tax department as a part of the rules and regulations of the Income Tax Act. That may be tax or interest or fine or any penalty. So simply assessee means a person who pays any sum of money to the income tax department or the government as a part of the rules in the Income Tax Act. That is known as assessee. Okay, I think it is clear. Then next we can move to the next term, that is assessee in default. An assessee who fails to fulfill their duties under the Income Tax Act, such as deducting and depositing TDS, tax deducted at source, or filing return on time. Okay. This assessee in default means an assessee who fails to fulfill his obligation of the payment of tax liability. If any person fails to pay his tax liability, then that person is known as assessee in default. That's the simple meaning of assessee in default. So I repeat, assessee in default means any person who fails to fulfill his tax liability. Then that person is known as assessee in default. The consequence of become an assessee in default is that assessee in default is liable to pay 1% interest per month on its tax liability. That's the consequence of becoming an assessee in default. Is liable to pay 1% interest per month on its pending tax liability. Okay, clear. Next, we can move to the next term, that is previous year and assessment year. First, we can discuss what is previous year. The term previous year is represented by PY, the capital letter PY in income tax. This is one of the important term related to income tax, the previous year. Previous year means a financial year in which income is earned. This is when your earnings actually occur. So in income tax, previous year means a financial year. Then first, what is financial year? Financial year means a period of 12 months commencing on the 1st April of a year and ending on the 31st March of the next year. That is financial year. Then the previous year is a financial year in which the income is earned by a person. In such a way that every year can be a previous year. Previous year simply means a period of 12 months that is commencing on the 1st April of an year and ending on the 31st March of the next year. Then every year can be a previous year. Or previous year is a year in which a person earned his income. Okay. The current previous year is 24-25. That is, in 24-25, the persons or the individuals earned income. Then they paid tax on that income in the coming year, on the next year. Okay. The next we can discuss the assessment year, the term assessment year. This assessment year is represented by the letters AY, capital letter AY in tax. It means a financial year immediately following the previous year, during which your income from the previous year is assessed and taxed. So, assessment year means a financial year immediately preceding the previous year. Or, assessment year is a financial year in which the income is assessed or the tax is paid on the income that we earned in the previous year. That is assessment year. Simply, the assessment year is the year in which the tax is assessed on the income that we earned in the previous year. So, this if our previous year is 24-25, then the assessment year is 25-26. We earn the income in the year 24-25. Then we pay the tax on that income in the assessment year 25-26. Simply, we can say previous year is the year in which the income is earned and the assessment year is the year in which the tax is paid on the income that we earned in the previous year. I expect all of you understand this meaning of the previous year and assessment year. Next, we can move to next term, that is income. The term income is not defined in Income Tax Act. Instead of that, the Income Tax Act includes some items that are coming under the term income. For the taxation purpose, the term income is classified into 5 heads. Okay, that is, the first head is income from salary, second head is income from house property, third is profit and gains of business or profession, fourth one is capital gain, and the fifth head of income is income from other sources. That is, for the taxation purpose, the overall income of a individual person is classified into 5 heads. That is income from salary, income from house property, profit and gains of business or profession, capital gain and income from other sources. Then first we can look into the head, the income from salary. Income from salary includes all the incomes that a person earned from his employer. Whatever the income a person gets from his employer is coming under the head income from salary. That may be basic salary or allowances or perquisites, etc. Or the income that a person gets from his employer is included under the head income from salary. Then second head is income from house property. Income from house property include the rental income. For example, if a person has a house property, then if that person gets any rental income from that house property, that income can be included under the second head, that is house property. Okay. Then third head is profit and gains of business or profession. If a person is doing any business or if a person is a professionalist, they may get income from that source, maybe from business or the profession. The income that a person gets from his business or profession is included under the head profit and gains of business or profession. Okay. Then fourth head is capital gain. Capital gain includes the income that a person gets from the transfer of any capital asset, from the transfer or sale of any capital asset. For example, from the sale of any building, from the sale of any land. If a person sold his building or land, he may get profit from that. That income is included under the head profit and under the head capital gain. Okay. Then last head of income is income from other sources. Income from other sources include all the incomes of an individual that are not included in other four heads. That is included in the fifth head. For example, the income from winning from lottery or income from winning any games or crossword puzzles. All these are included under the head income from other sources. These are all about the term income. Next, we can move to the next term, that is gross total income and total income. Okay. First, we can discuss what is gross total income. That is GTI. GTI. Gross total income means the sum of all your income calculated under the five main heads of income before any deductions are applied. It's your initial taxable base. So this GTI or gross total income simply means that the sum total of the income that an individual person gets from his five heads of income. We already discussed about the five heads of income. So gross total income means the sum total of the income that an individual person gets from his five heads or the five categories of income under income tax. Okay, I think it's clear. The next term is total income. Total income means the income on which the tax liability is calculated. That is total income. It's the income on which the tax liability is calculated. In other term, we can say that total income means when we deduct the deductions from 80C to 80U from the gross total income, we get the total income. In income tax, there are so many deductions available to individual. That is 80 deduction under the section 80C, 80U, 80G, 80E, like that. If we deduct these deductions from the gross total income of a person, we get the total income of that person. We calculate the tax liability of an individual on the total income of that person. Okay, so total income means when we deduct this deductions from gross total income, that is total income. Simply GTI minus deductions from 80C to 80U is the total income. Okay, clear. The next term is that ITR. ITR means income tax returns. Income tax returns are the forms that are used by a assessee for submitting the details of its income to the income tax department. There are so many ITR forms. That is ITR 1, ITR 2, ITR 3, like that, up to ITR 7. There are 7 ITR forms. These forms are used by an assessee for submitting the details of its income to the income tax department or to the government. For most individual taxpayers, the standard due date for filing ITR is July 31st of following assessment year. That is, the date of submitting the ITR form by a taxpayer to the income tax department is the July 31st of the following assessment year. That's the date for filing ITR. Okay. Then the next term is accelerated assessment. This is our last term, that is accelerated assessment. Before discussing the term accelerated assessment, we must know firstly what is assessment. Assessment simply means the computation of total income of an individual and the calculation of the tax liability on it. That's the process of assessment. Computing total income and calculating the tax liability on it is known as assessment. Then what is accelerated assessment? Accelerated assessment means a faster or early assessment. Doing the assessment in early stage. This may be due to various reasons. For example, if an individual person is doing a business and his business is discontinued. Okay, if a person discontinue his business, then he has no income, no chance of income from that business in the coming year. Then income tax department asks them to make the assessment of that income in the previous year itself. Okay, that's one case of accelerated assessment. Another example is that if an individual person earns some income from India and he planned to leave India and he planned to leave India into the abroad without an intention to coming back to India. In such situation also, income tax department asks that individual person before going to abroad make the assessment of the income that he earned from India. Okay, it's another case of accelerated assessment. So accelerated assessment simply means doing the assessment as early as possible or doing the assessment in the previous year itself, paying the tax on the income in the previous year itself. That is accelerated assessment. Okay, I hope all of you understood all the terms that I discussed in this video. We can discuss more terms in my next video. Thank you for watching. Thank you so much.